I remember feeling completely trapped in that endless cycle of trying complicated trading strategies that promised the world but delivered absolutely nothing in the real markets. If you are running on that same exhausting treadmill right now, I want you to take a deep breath. I'm going to walk you through a simple, incredibly powerful trading approach that completely changed how I look at the charts, and it's something you can start using the moment we finish talking. You don't need a screen cluttered with confusing indicators, and you don't need a massive account to make this work. When I trade this way, all I rely on is a clean chart, strict discipline, and the exact step-by-step method I'm about to show you. This is built entirely on how smart money actually moves the market. Trust me, once you truly grasp this concept, you will never see price action the same way again. I call this the sweep and flip protocol. It's a high win rate day trading strategy directly aligned with how institutions trade. You can easily apply this entry model across Forex, crypto, indices, stocks, and metals. We are going to look at how to spot liquidity traps so you can stop being manipulated by big institutional players. I'll give you the exact rules I use for entries, stop loss placement, and take profit logic, giving you a complete actionable trading plan you can use today. To make sure it all clicks, we'll walk through real chart examples with clean execution and expose the top mistakes that absolutely destroy a trader's results.
Before we get our hands dirty with the charts, do me a quick favor, make sure to hit that like button, subscribe to the channel, and turn on the notification bell so you never miss a breakdown. Let's start right at the foundation. Institutions don't enter the market the way you and I used to as retail traders. They rely on incredibly advanced algorithms engineered to track one single vital element in the market: liquidity. To put it simply, liquidity is just clusters of stop losses and pending orders waiting to be triggered. The majority of retail traders place their stops right under an obvious support level or just above a clear resistance zone. That is precisely where smart money focuses its attention. Once enough liquidity builds up in one of these specific zones, those institutional algorithms will launch a sudden, aggressive move, a fake breakout, or a sharp, violent candlestick wick designed entirely to sweep those stop losses. When those stops get hit, they automatically convert into market orders, giving the institutions the massive volume they need to get clean entries at the absolute best possible price. But those institutions aren't actually trading the breakout itself. They are using that engineered spike as a clever opportunity to position themselves heavily in the opposite direction. That is why, almost immediately after you see a liquidity grab, price will often snap back aggressively in the other direction. The retail traders get trapped, while the smart money is already sitting pretty in the winning direction. The market hunts liquidity first. It doesn't care about your favorite technical setup or indicators. If you don't recognize this reality, you are simply providing your own stop loss to be used as someone else's profitable entry. For these institutional algorithms to execute effectively, the market has to be prepared in a very specific way. This is where my three-phase playbook comes into action, and it's a pattern I watch for constantly. The first phase is loading liquidity, or the accumulation stage. You'll notice price starts consolidating in a relatively tight, quiet range. Nothing dramatic is happening on the surface, but beneath that calm water, liquidity is actively being gathered. Retail traders stack their stop losses just below the range, while breakout traders place buy stops just above it, creating the perfect setup for a trap. The second phase is triggering the trap, which is the manipulation stage. Suddenly, an aggressive move violently breaks out of the quiet range, sweeping away all that accumulated liquidity. Retail traders see this and instantly believe it's a genuine breakout. Some jump in late, frantically chasing the momentum, while others get stopped out in seconds. But none of this is the real move. It's just the trap being sprung. The third and final phase is executing the real move. Once all that liquidity has been harvested, the institutions step in with full volume in the exact opposite direction of the trap. This is the true move, the one backed by massive institutional flow. Price will now move incredibly cleanly and decisively, leaving retail traders completely in the dust while smart money is already riding the wave they engineered. This pattern repeats week after week, and in some fast-moving markets, it happens multiple times a day. Once you train your eyes to recognize this three-phase playbook, you will start spotting it everywhere you look on the charts. Now that you understand how these big players engineer traps, it's time for us to reverse the roles and position ourselves with them, not against them. Our main goal here is to catch that true institutional move, the one that happens right after the liquidity sweep, exactly where smart money flows in and retail traders get caught completely off guard. But I have to warn you, precision is absolutely everything here. Your timing and your understanding of structure are the ultimate keys to making this work consistently. This isn't a setup you can just trade randomly at any odd hour of the day. It really only works during a very precise timing window near the tail end of the Asian session and moving directly into the London Open. That is exactly when a massive flood of liquidity enters the market and when institutional traps are most frequently triggered. To follow along with this strategy, you won't need a messy chart. In fact, you'll only need one clean, completely free indicator just to mark the trading sessions clearly, so your chart stays clutter-free. We look for and execute our setups on the 15-minute time frame. That's where our entries live. But before we ever pull the trigger on a trade, we always perform a quick top-down check on the 1-hour chart to keep us safely aligned with the overall institutional direction and smart money flow. When I look at my chart, I first identify the Asian session, followed by the London session, using that simple session indicator to highlight them. My analysis really begins as the Asian session winds down. At that specific moment, I mark the most recent high and the most recent low of that range. This area represents our accumulation phase. Next, we just wait patiently for the London session to open, because that is when volatility kicks into high gear and the real game begins. Right before the true move happens, we expect to see that liquidity sweep. We are watching for institutional algorithms to hunt those stop-loss clusters, sitting right above those highs or below those lows. Here is what that looks like in a bearish scenario. Price pushes sharply above the recent Asian high, clears out the liquidity, and then immediately snaps right back down below that level. That is a textbook liquidity, grab a deliberate trap to lure in breakout buyers before reversing hard. Once you spot this setup, the execution is incredibly straightforward. You enter a sell position the moment that reversal candle closes back inside. Place your stop loss just above the highest point of the liquidity sweep and set your take profit right at the most recent Asian low. That is the bearish sweep and flip protocol in action. Now let's flip it over and look at the bullish scenario. Just like before, we start at the end of the Asian session and clearly mark the most recent high and low. To the institutional algorithms, these are high-value liquidity pockets packed with stop losses. The typical sequence unfolds like this. Price dips sharply below the recent Asian low, sweeps the liquidity, and then reverses violently back above that level. That sharp reversal is your ultimate confirmation. You open a buy position the exact moment the candle closes back above that key level. Your stop loss goes just below the lowest point of the liquidity sweep, and you aim for the next major structure high as your target. This gives you a precision entry that is perfectly aligned with institutional flow. But remember, this execution is only one half of the equation. Next, I'm going to show you how I use a fast top-down analysis to filter these setups. This ensures we don't just take random low probability sweeps, but only the ones backed by a strong directional bias. Let's walk through a real-world example together on the Australian dollar Canadian dollar 15-minute chart so you can see exactly how I do this. Before we do anything else, we need to set up our session indicator on TradingView. Go ahead and click on the Indicators menu at the top of your screen and type Sessions into the search bar. The exact one I use is called Sessions by JRFX Addict. Click to add it to your chart. Hover over the indicator name, click the Settings gear icon, and open up the Style tab to tweak the settings for maximum clarity. Uncheck the New York session entirely to get rid of any unnecessary clutter on your screen. Next, change the Asian session color to a clear red, and set the London session color to a vibrant green. Now look at your chart, it's beautifully clean and easy to read. You can instantly see exactly where the Asian session ends and where the London session begins. Now let's apply the rules step by step. In this example, we are right at the end of the Asian session, and the London session is about to open in just 15 minutes at 8 a.m. London time. Our very first task is to draw a line at the most recent high and the most recent low of this Asian range. Now, watch closely to see what price does the moment London opens. It dips right below our marked low, sweeps the liquidity sitting there, and then instantly snaps back to close firmly above the level. That is a textbook liquidity sweep. It's classic institutional behavior. During the London Open, they trigger a fake directional move to trap retail breakout sellers, and then immediately reverse into the true direction. But because you now understand the game, you aren't falling for the trap. You are getting ready to trade with the smart money. However, before we pull the trigger on this 15-minute chart, we must always perform our quick top-down analysis. Even though our entry setup is right here on the lower time frame, we always confirm the major market direction using the 1-hour chart first. Let's switch over to the 1-hour time frame and temporarily hide our session indicator so we can get a totally unobstructed view of the price action. Looking at the 1-hour chart, it is immediately clear that the market is in an overall uptrend. More importantly, price has recently pulled back into a previous resistance level, which is now acting as a strong support zone. We can see a powerful bullish rejection candle forming right at this key area, signaling that buyers are stepping back into the market and the larger uptrend is ready to resume. This gives us a clear bullish bias from the higher time frame, which perfectly aligns with the liquidity sweep setup we just spotted on our 15-minute chart. With our bias confirmed, we jump back down to execute. We take our buy entry the exact moment the 15-minute candle closes back above that swept low. Our stop loss goes just a few pips below the lowest point of the liquidity sweep, and we place our take profit at the next significant structural resistance level on the chart. I always make sure I am targeting at least a minimum 2-to-1 risk-to-reward ratio. As you can see, the moment the trade was live, price moved beautifully and smoothly in our direction, hitting the target with absolute precision, exactly as planned. Let's look at another real example, this time on the US dollar Swiss franc 15-minute time frame, to really drive the point home. We start exactly the same way, by marking the most recent high and low of the Asian range to define our zone. Now watch what happens the moment the Green London session opens. Price shoots violently above the recent Asian high, but it instantly rejects that higher price and closes aggressively back below the level. That is a flawless liquidity sweep. It's a beautifully engineered fake breakout designed to trigger the buy stops of breakout traders and the stop losses of early shorts before the real move begins. That sharp spike isn't the real institutional move, it's just the trap being sprung. The real move only starts after that sweep occurs and price flips direction. But remember our golden rule. Before taking any entry, we must confirm our direction with a quick top-down analysis. Switching over to the 1-hour time frame, we can see that the market is currently caught in a larger range. Crucially, price has recently rejected a major overhead key resistance area and is currently expanding lower toward a significant demand zone below. This tells us there is strong, active bearish pressure in the market, which perfectly aligns with the short setup we are eyeing on our 15-minute chart. Knowing the higher time frame has our back, we return to the 15-minute chart to execute the trade. We enter short at the exact close of that bearish candle that flipped back below the swept high. Our stop loss is placed safely just above the highest point of the liquidity grab. We set our take profit down at the next key support level. This setup easily gives us a minimum 2-to-1 risk-to-reward ratio, perfectly meeting all our mechanical rules. And look at how beautifully that played out price dropped cleanly, without any stressful drawdown, and smashed our target. Now, I need you to pause and listen to me very carefully on this next point, because it is incredibly critical. Even if you memorize this strategy perfectly, if you make these next 2 mistakes, absolutely nothing will work for you. You could have the single best strategy on earth, but ignoring these rules will completely destroy your results. Let's break down the first and most common mistake I see traders make, ignoring the higher time frame. This is a fatal mistake, and it is the #1 reason traders blow their accounts even when they think they've found a flawless setup. Let me show you exactly what I mean. Look at this scenario on the Australian dollar Canadian dollar 15-minute chart. The market appears to be trending down, so everything seems normal on the surface. We mark our most recent Asian session high and our most recent Asian session low. Then we get this. Price breaks above the recent high, sweeps the liquidity, and closes back below. It looks like an absolutely perfect bearish sweep and flip entry, right? So what happens next? Most traders would blindly jump in immediately. They sell at the candle close, put their stop loss right above the sweep and target the lower level. But look at what happens immediately after price reverses hard and aggressively hits their stop loss. At this exact moment, most traders get incredibly frustrated and start thinking the strategy doesn't work. No, the problem isn't the strategy at all. The problem is that you completely ignored the bigger picture. Let's fix this mistake the smart way. Before taking that trade, we should have done our quick top-down confirmation by jumping up to the 1-hour chart to see what the smart money was actually doing. While the 15-minute chart looked bearish, the 1-hour chart shows the market had formed a clear double bottom, which is a major bullish reversal pattern. Even bigger than that, there was a massive liquidity sweep at a key higher time frame support zone, trapping sellers and heavily loading up buy positions. This meant institutions were actively accumulating long positions. So when you took that sell trade on the 15-minute chart, you were actually trading directly against the real macro direction of the market. That is why it failed. you cannot trade the sweep and flip strategy blindly on a lower time frame. If the higher time frame is telling you the opposite story, your trade will almost always fail, no matter how pretty the setup looks. Your entry time frame gives you precision, but the higher time frame gives you your true direction. If you ignore direction, you will lose. The second massive mistake is trading without a minimum 2-to-1 reward to risk ratio. This is one of the biggest reasons traders end up losing money with this strategy over time, even when they are technically executing the setups correctly. The sweep and flip protocol is designed to be a sniper strategy that gives you incredibly clean entries. But if you ignore your mathematical reward to risk ratio, you will slowly destroy your account performance. Let me show you exactly how this trap works. Look at this setup on the US dollar Swiss franc 15-minute chart. During the Asian session, the market was moving lower, and once London opened, we spotted a beautiful, clean liquidity sweep right below the most recent low, a perfect bullish sweep and flip setup. We mark our entry at the close of the reversal candle. Everything looks fantastic up to this point. But here is where the average trader goes wrong. They get scared or impatient and they place their take profit far too close to their entry, giving the trade only a basic 1-to-1 reward to risk ratio. This is a massive trap. Sure, you might win this specific trade, but you will absolutely lose money in the long run. A 1-to-1 reward to risk ratio means that a single losing trade completely wipes out a winning trade. When you factor in broker spreads, commissions, and occasional slippage, you are actually losing money slowly without even realizing it. This is why professional traders refuse to accept low reward to risk setups. Now, let's look at what happens when we handle this the exact way a professional would. Instead of settling for a tiny weak target, we extend our take profit out to the next major, logical resistance level on the structure. By doing that, this exact same trade now gives us a phenomenal 3.4-to-1 reward to risk ratio. This means for every single dollar we risk on the trade, we stand to make $3.40. This is how professional minds operate. Small, controlled risk paired with large, asymmetric rewards. That is how you grow a trading account consistently, even if you just have a normal win rate. Look at what price did. Next, it exploded powerfully in our direction, easily smashed through that 3.4 reward target and continued to climb higher. The setup didn't just work, it paid out over 3 times more money simply because the target placement was handled intelligently. Always remember, never take a sweep and flip setup if it offers less than a strict 2-to-1 reward to risk ratio. If you follow these rules diligently, this strategy will completely transform your trading. If you ignore them, the market will punish you. I truly hope this deep dive has given you real clarity and the confidence to go out and look for these setups yourself. If you got real value from our chat today, please hit that like button, subscribe to the channel, and turn on that notification bell so you don't miss out on my next strategy breakdown. Thank you so much for hanging out with me, and I will see you in the very next video.